The street gives up opening gains despite positive global cues. The Nifty hovers around 24,300, led by weakness in FMCG and healthcare stocks. The broader market, however, trades with steady gains.
PNB Housing gives up some of the gains but is still up 6.5% after posting its fourth quarter results. The net interest margins come in at a 6-quarter high while gross NPAs are at a 22-quarter low.
TVS Motors skids close to 4% even as the company reports a strong quarter after the management warns that the first quarter FY26 could see some moderation in growth.
Tata Technologies has slipped nearly 6% after nearly 4% equity worth close to 1,100 crore rupees changed hands at 683 rupees a share. Sources say that TPG could be the likely seller.
Pharma is under pressure after a fire at its Andhra unit. However, the management says there's no material financial impact from this particular incident. Hello and welcome to Chartbusters. We are coming to you live from the CNBC-TV18 Motilal Oswal studio. I'm Nigel. With me is Harbaz. And Harbaz, we have a flat screen as we speak. Though the market started off well in the green, I think we're facing some resistance at higher levels. So on the Nifty Bank, the 56,000 odd mark, it seems that the bulls are making a bit of a meal of that because the bears are coming to fight out there. And on the Nifty as well, that 24,450 odd appears to be a bit of a resistance zone. So let's see how it goes. But for the time being, we've come off the highs of the day.
There's some bit of geopolitical tensions as well,
Indeed.
right, on the border, and that is causing that fall from the highs. And of course, it is this conundrum, right? We are failing to cross that high made last Friday, which was 24,365. We did make that on an intraday basis. At the highs of the day, we were well above that. We were at 24,460, but we're failing to sustain at above those levels. 24,365 is Friday's high. In fact, the highs of the last 4 trading sessions too have been in this 24,340 to 24,360 range. So it's this 100-point range that where the Nifty is finding some bit of resistance. Of course, we need to make sure of the fact that there are a lot of earnings reactions today, a lot of earnings reporting today as well. See the likes of Trent, Bajaj Finance and the likes, and a lot of broader market names as well. So it promises to be an action-packed day. Of course, it's a truncated week, so you need to keep that in mind as well. But what are the charts indicating right now? Shilpa Raut of Prabhudas Leeladhar joins in for just that and also with some trading ideas. Shilpa, good morning. Thank you for joining in. We've had a substantial recovery from the lows, right? And it's just because of some of these geopolitical tensions that we're taking a bit of a pause or adopting a cautious stance. What do you do here with the index now, both for the Nifty and the Nifty Bank? And of course, your stock recommendations for the morning.
Good morning, Nigel and Thomas, and thank you for having me on the show. If you look at the rollovers analysis, we were very clear that 24,600 should act as a resistance and the support is at 24,000. So this range is very much clear for this, at least for this truncated week. So for now, that range on the upside of 24,500 to 600 is acting as a resistance. So any rise towards that can be an opportunity to go short, and any fall towards 24,200 can also be an opportunity to go long. So as long as we are not breaching above that, so we can play this range very well. Talking about Bank Nifty also 56,200 is a resistance, and we see time and again 56,000 zones, so it's acting as a tough upside resistance there. So as long as we are not above 56,500, we'll not see any good upside towards 57,000 or 58,000, as a matter of fact, of new highs that we talk about. So for now, I wouldn't say that there's a trend reversal, but yes, some profit booking on the higher levels are definitely pitching in.
Okay, all right. Let's focus on individual stocks. And Shilpa, what's on your radar?
Nigel, I have one buy. The buy would be in Britannia. Britannia futures trading at around 5,500. I believe, stock is showing some sort of resilience, and it is attempting a breakout for levels of 5,600 to 5,650. So keep a stop loss of 5,480 in futures and stay long in Britannia. The other one would be a sell. Sell would be in Coal India. Coal India has slipped below 500. So I believe, levels of 460 can also come in again. So the stop loss should be at 405 and look for levels of 360 in Coal India.
All right, Shilpa, thank you so much for sparing time and joining us today with your views on the index and on specific stocks as well. Shifting focus to our special segment where we get you a few ideas for profit from Money Control Pro. Neha Dave joins in today with a stock that she's tracking very closely.
Today's stock pick is HDFC Bank that posted muted earnings in FY25. However, the improvement on the balance sheet front was positive. In FY25, HDFC Bank focused on managing the balance sheet that got unaligned following the merger. Moreover, the bank had a cautious view on the credit environment. Consequently, the bank's loan book growth of around 8% in FY25 was lower than the industry growth. However, the bank saw a strong deposit growth of 14% in FY25. Thanks to slower loan growth and solid deposit growth, the bank's credit to deposit ratio improved to 97% as of March end from a peak of 110% that the bank saw in December 23 following the merger. Going forward, as per the management, in terms of advances growth, the bank will match the industry growth in FY26 and it will grow faster than the industry in FY27. With the likely reduction in the policy rates further, margin will come under pressure over the next couple of quarters as loan book will get repriced faster than the deposit book. However, the margin will get support in the medium term as HDFC Bank replaces market borrowings which it has inherited due to the merger with relatively low cost deposits. Overall, higher advances growth, range-bound margins and stable asset quality will lead to better earnings in FY26 and which can lead to valuation re-rating for the bank. Currently, the bank is trading at around 2 times core book value estimated for FY27 after adjusting the valuation of subsidiaries. The valuation is reasonable given that the bank delivered return on asset of around 1.9% and return on equity of 15% in FY25. Moreover, HDFC Bank is trading at a 10% discount to ICICI Bank in terms of valuation. Long-term investors should accumulate the stock.
All right, thanks for that, Neha. Well, time to slip into a short break. On the other side, we'll be joined by the Managing Director of Castrol India. Mr. Kedar will be waiting by.
Welcome back. You're watching Chartbusters here on CNBC-TV18, continuing with corporate conversations. Then Castrol India's quarterly performance weakened on a sequential basis. Margins also came in below the guided band of 22 to 25%. And to discuss the quarter gone by and the road ahead for the company, we are now being joined by Kedar Lele, who is the Managing Director of Castrol India. Kedar, good morning. Thank you for joining in. You know, your margins are below the guided band. It's been a subdued start to the calendar year as well. Could you tell us what are the challenges that you faced during the quarter and how is the current quarter shaping up as well? We are 30 days into the new quarter. So what's the on-ground situation now as well?
Good morning, Horvaz. Namaskar. Very good to see you and thank you for getting me on the show. While you started with the reflection on this quarter being softer to preceding quarter, I would really request you to really focus on year-on-year performance. And I'm quite satisfied with how the quarter one of this year has been. We have grown our volumes by 8%, our top line by 7%, and the PAT has come at 8%. Now, when the quarter started, to be honest, I was really worried because of the clouds on our larger geopolitical scenario that all of us are aware of, our forex ratios, because the dollar was rupee dollar conversion was getting weaker and we were seeing those headwinds. And in those circumstances, this performance is really delightful. It's come because of innovations that we've done, because of our market coverage that has gone up and sustained executional excellence that we have seen in the market. So as a whole, we are very happy. And I keep explaining everybody that the Q4 of the calendar year is not the right thing to compare. We have always given the guidance of our profitability in 22 to 25, and this quarter has come at 22, despite all the headwinds that we saw in the business and the environment.
All right. Hi, Kedar, and thanks a lot for joining in. This is Nigel on this side. So let's focus on the yearly aspect then. What kind of a volume growth can you guide us for the year? And as you said, last quarter had a couple of headwinds that forced the margins to come in at the lower end of the guidance band. Given that a couple of input costs have cooled off, you're focusing on some operational efficiency as well. Should we see an improvement in margins in the coming quarter?
I resist from giving a forward guidance on the business, to be honest, because what keeps us going is a good insight on the long-term focus on our segments, which is trucks, cars, and bikes. We stay focused on how we land our innovations, like we did with Shah Rukh Khan taking the Garmi Maybe 3x prediction during this quarter. And that, of course, in the summertime will become more relevant for all of us. And we keep expanding the volume growth for the business ahead of the industry. If we did that with discipline, I have no doubt that earning per share will continue to grow handsomely in the time to come. Now, you asked a question, and I should say that in this quarter, the team prioritized on our ASP investments, which is advertising and sales promotion investment, and it was much higher than what we have done in the past, almost 45% higher than what we would have done in the past, and that augurs well because in the beginning of the year when we invest behind our brands, that creates a fuel for growth. So I'm quite pumped up with the strategic choices that we're making and the performance that we will deliver in the time to come.
Kedar, you spoke of investments and that they have been substantially higher behind the brand. Does that continue for the rest of the year as well? And if so, does that impact your margins, or do you maintain that for 2025 as well, you'd remain within this 22 to 25%, maybe slightly higher than what you reported in 2024?
That's a great question, because the everyday balance that one needs to do while running business, as they say, walk and chew gum at the same time, deliver the volume, deliver the margins. And I genuinely believe that being able to do that on a daily basis, on a monthly and a quarterly basis, is the art of running a successful business. So you will see us driving growth on volumes. You will see us investing behind our brands, being more, bringing ourselves closer to our consumers, innovating, and then performance will come out as profitability for our investors and stakeholders.
All right, Kedar, you're refusing to give us any numbers, or avoiding it at least as of now. Maybe the next time around we'll squeeze you on some numbers. But for the time being, at least give us some inputs, on the EV opportunity, the data center opportunity as well. You all were talking about that in the past, but I think the last couple of quarters that's been missing. So if you could tell us, what is the opportunity and how are you all progressing on both these two fronts?
Yes, I think, Nigel, great question. The challenge in front of oil and gas industry, and maybe specifically for lubricant industry, is to be able to perform while getting ourselves ready to transform for the time to come. And both EV and the data center opportunities are small at the moment, will become larger as the time passes by, and will become core to most of our industry in, say, 10 to 15 years. Now, are we ready for that? The answer is absolutely. For example, the Castrol ON range of products, advanced transmission fluids or coolants, are the products being used by the EVs in India and abroad. We have invested huge amount of capital in our research and development, both in London and in India and across the world. And that prepares us for the transition that will take place. Why I don't talk about it in my result conversation is because the contribution is insignificant at the moment. It is exciting to talk about these things, but does not make a difference to this quarter or next quarter's results. So it's important that we keep performing while preparing ourselves to transform in the time to come.
Will you be setting up at least a separate marketing vertical for both these two segments, EV, data center as well? If you could give us some clarity on that front.
So thing is, if your customers come from a different segment, you do need dedicated manpower to service those. And we've already created those manpower cells across functional team to be able to approach those customers, work with the opportunity, and of course, tap them in the time to come. It is a different route to market. When it comes to EV, it's the same because most of our current OEM partners or OEM customers are in fact evolving. Tata Motors is the leader, and we are a very frontline partner when it comes to EV fluids for them. When it comes to data centers, it's a different business, and we have now dedicated manpower which is working with some of the large data centers which will go for immersion cooling or direct chip cooling, which will involve our coolants and fluids.
Paucity of time, Kedar. So just bunching two questions into one. If you could share the volume growth number for the first quarter, what was it? And if you could break that up as well as to what led to that number. Was it personal mobility? Was it industrials? Or was it commercial vehicles? And part two of my question, which is on a different tangent, is that you had a market strategy of crude oil prices being around $75 to $80 a barrel. With all the volatility that you have seen in crude oil prices falling to 60, now heading back to 70, do you see some benefits percolating into the current quarter as well?
Okay, two very different questions. So let me answer the first question first and then conclude with the second one. The volume growth has been 8%. And if you've been an observer of our business in the industry, you will realize it's one of the best that we have delivered so far. And this has come on the back of very handsome double-digit growth in our passenger car as well as commercial vehicle oil segment. We have also been able to deliver healthy growth and high single digit for our two-wheeler business. So all across personal mobility and commercial, we've been able to fire on all the cylinders. Otherwise, growing this large business in lubricant in high single digit volume would have been really, really difficult in a quarter like this. And hence the combination of all of three has worked really well for us. Now, on your question on extremely volatile crude oil, now, I keep educating everyone that crude oil is of course the raw material that goes into creation of base oil, and base oil is the raw material for lubricants. And while we see a correlation, the correlation is not very strong between the prices of crude oil today and the prices of base oil in the market today, because there's always a lag and the correlation is weak. Now, it does benefit sometimes, and it's adverse in other times. The task or a job of a brand like ours is not to pass on these shocks on a regular basis to our consumers, because customers don't like those shocks. So we'll absorb the shocks when the prices are high, and we will of course make some margin for a short period when the prices are going down. It is a management of my team, which of course invests in these to deliver consistent results for our stakeholders. So as long as I'm predictably boring, I think I'm doing a good job, and so is the company.
All right, Kedar, thank you so much for sparing time and joining us today to discuss your quarter gone by. Wish you good luck for the rest of the year as well. The management of Castrol India discussing the road ahead for the company. The stock, though, at the lowest point of the day, almost 2.75% lower at 204. The other stock that's not doing well today, though, is TVS Motors, and that is despite a strong fourth quarter, because the management is indicating some caution on the growth front. Sudarshan is joining in with more on that. Sudarshan.
So I'll divide it in two parts. First, talking about the earnings. Earnings, by the first look, it was in line or say beat. It had beaten the estimates of in Q4 FY25. Margin had come at 14% against our estimate of 13%. But that margin of 14% had factored in PLI benefits for the entire year. Now, if you exclude that PLI benefits, margin was at 12.5%, which was largely in line with all the estimates. Now, coming to the second part, that is the commentary. So we'll start with the global, where company sees the global growth to improve going forward. And one of the major markets, that is the African market, as per TVS Motor, African market has hit the bottom, and from here on only growth will improve. The second, coming to domestic growth outlook for FY26, as per the management of TVS, FY26 domestic growth outlook is same what the industry has seen in FY25. Now the question, why this stock is under pressure. Now talking about Q1, company is saying that Q1 there might be some moderation, because last year in April there was a base effect, so it might impact in April. But here also for month of May and June, company is saying there might be strong sales, considering the number of marriage dates this year is more than what it was in 2024. So earnings were beat, commentary is cautious, and especially talking about Q1, the commentary regarding Q1 might have weighed on the stock.
Okay, all right. Thanks a lot for that, Sudarshan. Well, let's focus on IndusInd Bank. They've announced that its deputy CEO has resigned with immediate effect, weeks after the private lender had disclosed accounting lapses in its derivative portfolio. Ritu is here to fill us in with more details. Ritu?
Well, thanks for that. In what is clearly a fallout of the accounting discrepancies in IndusInd Bank's derivatives portfolio, Deputy CEO Arun Khurana has resigned with immediate effect as of yesterday. As we'd reported a couple of weeks ago, this was likely because Khurana was overseeing the Treasury Front Office, which is the division responsible for the derivatives portfolio, where incorrect accounting had led to a near 2,000 crore rupee hit on the bank's P&L. In his resignation letter as well, Arun Khurana has cited the recent unfortunate developments linked to the discrepancies and this P&L hit as the key reason for his decision. Now, this resignation comes just a day after the bank disclosed that an independent investigation had identified the key individuals who were responsible, and the bank had stated that the board will determine changes and realign senior management responsibilities based on the report's findings. Now, we understand that this independent investigation was conducted by Grant Thornton, which has pegged the adverse financial impact at about 1960 crore rupees, which is very close to the 1979 crore rupee hit, which was determined by external auditor PwC earlier. The bank will now account for this loss in its fourth quarter earnings. Meanwhile, the Reserve Bank of India has already shortened CEO Sumant Katpalia's tenure to March next year, and as we had reported, asked the board to submit the potential CEO candidate names by October. So the accounting fallout is triggering top-level exits, and this may not be the last one.
Okay, all right. Well, time to slip into a short break. But as we do that, here's some good news for all our viewers. India's business news leader is now a click away. Introducing CNBC-TV18's all-new app. Get instant access to breaking news, in-depth articles, and financial world updates. All of this at your fingertips. Download the CNBC-TV18 app from the Apple Store or from the Google Play Store. Or you could simply just scan this QR code that's up for you on the screen. Sources tell CNBC-TV18 that India is considering restricting the export of electronics and e-commerce goods to Pakistan. The move comes against the backdrop of the escalating tensions between the two countries. Abhimanyu joins us to fill us in with more details. Abhimanyu?
Sources have indicated that after Indus Water, Indian electronics and e-commerce goods may face curbs for Pakistan because after passenger traffic, there is a likelihood that air cargo route over Pakistan may get severely impacted. Sources have indicated that the government is collating data from the Customs Department and several other departments to understand the logistics cost for exporters in case of any further disruptions. Also, plans are underway to assess the impact of trade to UAE and Europe as part of multifaceted preparations for a possible disruption which may happen for trade. Also, sources explained that direct trade between India and Pakistan is minuscule as most Indian goods are re-exported via third countries to Pakistan, and the third countries include nations like the UAE, Sri Lanka and Singapore, and it's primarily items like gold, gems and jewelry, electronics and e-commerce goods which are re-exported to Pakistan via these countries. Now, as per GTRI, Indian goods worth over $10 billion per year reach Pakistan from these third countries, which may face fresh curbs based on the assessment which is underway. It remains to be seen what happens with respect to the assessment and based on the stakeholder consultation, based on the information which reaches the government from various departments, any further action would be initiated.
Thanks a lot for that, Abhimanyu. Well, for the time, though, we'll have to wrap up on this edition of Chartbusters. You stay with us. Trading Hour comes up next.